Today is February 28th, 2026. The crypto world is buzzing with a familiar question. Can Bitcoin finally break through the monumental 100,000 barrier this year? This is not just hopeful chatter. It is driven by a powerful resurgence in market activity. After sideways trading and nervous sentiment in 2025, Bitcoin has found its footing. It has reclaimed the critical 68,000 level. This move was driven by the return of big money. Institutional investors are piling into U.S. spot Bitcoin ETFs. These regulated ETFs have opened the floodgates for new capital. A chart shows a sharp spike in ETF inflows in February 2026. The numbers tell a story. Single-day inflows have exceeded 500 million. That is a decisive reversal from previous sustained outflows. The market is no longer only retail-driven. Now it is shaped by large financial players making calculated moves. Momentum is shifting. The most compelling proof for a bullish 2026 comes directly from the ETF data. These are not small, speculative bets. We are witnessing a tidal wave of capital from established financial giants. BlackRock's iShares Bitcoin Trust, for example, has become a dominant force. In a single day, it has been seen absorbing nearly 300 million in new investments. That translates to a demand for roughly 4,300 BTC in just one trading session from one fund alone. Across the dozen or so spot ETFs available, the scale of the demand becomes staggering. After a period of net outflows, the trend has sharply reversed. In one recent stretch, U.S. spot Bitcoin ETFs recorded a massive 1.1 billion in net inflows over just 3 consecutive days. This marked the strongest performance since the middle of January, snapping a 5-week streak of net outflows. Such a reversal signals that U.S. demand is returning with conviction, not just testing the waters, but a confident dive back into the asset class. The Coinbase Premium Index, after 40 straight days negative, recently turned positive, corroborating ETF flow data and reinforcing that domestic institutional buyers are back. For years, the biggest shadow hanging over cryptocurrency was regulatory uncertainty. Investors, especially large institutions, were hesitant to commit significant capital to an asset class that could be upended by a single government decision. However, 2026 is shaping up to be the year that this uncertainty finally begins to dissipate in the United States. Under the stewardship of SEC Chairman Paul Atkins, appointed in 2025, the agency has shifted from enforcement first to constructive framework building. This progress is not just talk, it is being codified into law. The Clarity Act, focused on market structure, is reported to have an 80 to 90% chance of passing by April. The Genius Act, providing a framework for stablecoins, is on track for mid-July rulemaking. Amid a global race to attract capital and innovation, the SEC launched Project Crypto to replace outdated rules with a forward-looking framework. The goal: migrate markets onto blockchain platforms and establish clear guidelines for custody and trading. This shift removes a key barrier for conservative capital, pension funds, and endowments by providing needed guardrails. Beyond ETF headlines and Washington politics, there is a mathematical case for a 6-figure Bitcoin. Several models that quantify demand point towards significant upside. One model suggests Bitcoin is trading below its implied value based on historical flow relationships. Recent inflows should have pushed price much higher. It calculates a 41% gap, implying a target near 95,000 if correlations reassert. The lag between inflows and price may be a window before demand is fully priced in. This is not a guarantee, of course, but it signals this rally could run further, just to catch up with the money already in. Consensus points to a volatile but upward trending year. Predictions range from 75,000 to 250,000, with many clustering around 100 to 150,000. Standard Chartered sees 150,000. Carol Alexander cites a center of gravity near 110,000. Massive ETF demand, fixed supply, and improving regulation form the simple math behind these bullish conclusions. While the case for a $100,000 Bitcoin is compelling, risks could derail the rally. Nothing in markets moves in a straight line, and Bitcoin is famously volatile. If inflation proves stubborn and rates stay higher for longer, capital can flee risk toward safety. Regulatory developments, while a tailwind, could also become a headwind. A surprise amendment, a political roadblock, or stricter than expected rules could spook the market. A harsh crackdown in another major economy could ripple through sentiment worldwide. Large holders, whales, can move the market, especially near psychological levels like 100,000. Concentrated sales could overwhelm ETF buying and trigger leveraged liquidations into a sharp correction. Much optimism is priced in. If inflows slow or legislation lands with a shrug, momentum can stall. Failure to break key levels risks a longer consolidation and a narrative shift to exhaustion. Given the bullish signals and the significant risks, how should you position yourself? The right strategy depends on your time frame and risk tolerance. For the active or swing trader, caution and strategy are paramount. This is not the time to go all in. Consider scaling in. You can buy a small amount now and add if price breaks and holds above key levels. Use stop losses, decide where your thesis is wrong, and protect capital from sudden downturns. Watch daily ETF flows and on-chain signals closely. Sustained outflows can be an early warning to reduce exposure. For long-term holders, consistency wins. If you believe in multi-year value, short-term swings matter less. Dollar cost average. Invest a fixed amount at regular intervals, regardless of price, to smooth your entry. Do not bet the farm on one asset. ETF flows and regulatory progress build a bullish foundation, but the journey will be volatile.